Hi, everybody. Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania. And it's May 2025. So, guess what? We're doing the investment strategy update. And oh, yeah, by the way, we're actually getting it to you at the beginning of the month. The last couple of months, we've been running about a week late or so. So, again, this is the May strategy update. And I don't know about you guys, but what's on every investor's mind? Are we sick of tariffs yet? Again, what's interesting is this is a cartoon from 2018 during the first administration of Trump talking about tariffs, and we're still talking about tariffs now. Now, how's that affecting the market? Well, obviously, there was a lot of volatility in the month of April. We saw a sharp sell-off. We were down about 19.5% from the all-time highs in the S&P 500. And if you've been watching our videos, you know that we were dialing down the risk in our clients' portfolios last year for just such an event as that we had. And you could see that we bounced off of major support at 48.50 in the month of April. Now, if you look at this chart of the S&P 500, you can see that we've had a 10% bounce off the lows. Now, going back to April, I just want to let you know that our risk indicators were showing us the same or similar signs as we saw in February of 2020 during the COVID lows. Now, did that mean that we went all in for our clients? It did not. We did not go all in, but we did turn up the risk dial and add to selected equity positions to take advantage of this 10% pop. Now, I would not be surprised that we've gone almost straight up, as far as a 10% rally after about a 19.5% decline. I would not be surprised to see some backing and filling here, but I do think the second quarter of 2025 is going to be a positive for the equity markets, so stay tuned. What's happening in interest rates? Well, again, you saw volatility in the stock market. We saw a tremendous amount of volatility in the 10-year Treasury. We saw the 10-year Treasury spike to 4.5%. Rumors have it that there was a foreign investor, Japan, that was supposedly selling 10-year treasuries in the overnight market, and that's why it sparked a sell-off, and we saw yields rise to 4.5%. But since that time, yields have come back down to 4.25% on the 10-year Treasury. We think that's fair value. We think we're kind of in the middle of the trading range as far as interest rates go. If we see interest rates back at 4.5%, we'd be lengthening duration. If we saw interest rates this year below 4%, we'd probably be shortening duration or buying shorter term bonds. But right now, the 10-year Treasury is at 4.25%. It still represents a very good value for bond investors at this point in time. Now, let's kind of conclude here a little bit. This is a short update. We might be bringing you another update in a couple of weeks with some of the news events that are pertaining, but remember, April tested that important support at 48.50 on the S&P 500. Again, our risk indicators, and I'd be happy to talk to anybody about what we use. We use about 9 different risk indicators, tell you when the market's fully valued, tell you when it's undervalued, tell you when the market's exhibiting signs of stress or risk, tell you when the market is actually looking to be a good place to invest. And we saw that actually in the first part of April, during that spike down, we were starting to buy selected positions in dividend and value stocks. Also, international stocks we think are going to be a winner this year as well. So we did increase equity exposure, but again, we're not pressing the pedal to the metal yet. I actually think you're going to get a better buying opportunity or a good buying opportunity probably sometime in the third quarter. But looking at interest rates, I still believe that sometime this year, CD rates, short-term bank CDs are about 4.25%. I think you'll see those closer to 3.25%. I think you'll see the yield curve uninvert. So obviously an inverted yield curve means that short-term rates are higher than long-term rates. And right now we kind of have a flattish to inverted yield curve where short rates are slightly higher than the 10-year Treasury right now. But I do believe that by sometime in the third quarter, I would not be surprised to see short-term interest rates around the 3% range. So we're entering into a big earnings season. When you see this video, you're going to see some of the big Magnificent Seven stocks report earnings. Apple, Meta are on the board this week. We actually think earnings are going to be coming out better than what people realize, and that may extend this recent stock market rally But again, we're looking for a very choppy year this year, where depending upon headline news, talks of tariffs either being put on or taken off, rumors have it that the Chinese obviously are coming to the table to have serious discussions. The question is going to be, if we take off the tariffs, does that mean the market rallies back to new all-time highs? Again, our risk indicators are more favorable and more positive, but we are not saying go all in on the equity markets. But again, it does not look like earnings are deteriorating at the speed that many people thought that they would with tariffs. It looks like the US economy is much stronger than what people realize. I mean, I know there's a lot of anecdotal evidence about people going to restaurants and being empty, etc. But when you have over 600,000 people show up in Green Bay, Wisconsin for the draft, that tells you that people are still spending money out there. So again, kind of in summation, April was a poor month. May, we think, is going to be a better month with a rebound. Our risk indicators are getting more favorable. Interest rate volatility is leveling out, and earnings should help a better second quarter in the U.S. stock market for 2025. That's all we have for this update. We'll be back. Talk to you next month.